Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next, let's say, 30 minutes on Options Guide TV, because I do think we're going to cover a lot of things. We are in the heart of earnings season, and once again, the news headlines drives the market higher, and then what the Lord giveth, the Lord taketh away, and the news headlines come back out and start driving the markets lower. Not quite sure what we're trying to do in the tech space. Are we trying to give Apple a break? Are we not? The news came out that there was going to be a break on mobile phones coming from China and some reliefs on the tariffs. Stock popped, but it didn't really pop. It made a solid move to the upside, but then it came crashing back down, and now we see Apple down another $5 a day, 2.5% thereabouts, and it's trading at 197. So everything that it was positive has all been gone, and we're almost all the way back to where we actually put our long straddle on, which is kind of crazy. Now, I do believe in legging out, and I do believe that. And I probably should emphasize this, and this is a great example, a great learning example, as far as the Apple straddle is concerned. When the news came out about the tariffs, and I did this in my own account, I let the market run to the upside, and it wasn't making the 10% move that the long straddle needed to be profitable. And you're hoping to get that type of move on just one side, so like the call would pay for the put. So the market ran up and it started coming back and started showing weakness. And I just closed out the Apple long call for a small profit. Well, not too bad. I sold it for $14. I think I paid $10 for it. The whole straddle was about $20. $22 is what we did on the show. I ended up paying $20 for it a little bit later, adjusting the strikes. But our long straddle, when it was at 195, worked out in that we had a decent run up in Apple, and we saw Apple trading north of 200. And actually, let's pull up the chart. Let's just pull up the chart instead of trying to guess exactly where it went to. So we went to 210. So at that point in time,
share the screen again, Brian.
Okay. Yeah, everything disappeared for a minute there. 1 second. All right, so then, so we ran all the way up to 210. So if you're at 195 and you go all the way up to 210, you can definitely close out the straddle for profitability. Now, you're probably, and the way I was thinking too, was that this is the good news. We got the event. The event didn't know if it was going to be good news or bad news, but it was perceived as the good news that Apple was going to get a break on tariffs and everything's going to be hunky-dory in the iPhone production world. And then ultimately, the stock just started showing weakness. And so the stock ran up, could have gotten out if you would have hit it right at the high. But if you were like me, you thought the stock was going to keep going, started to show some weakness, sold the call, and now I'm just struggling to get out at break even on my trade. So the fact that it's down today actually helps my position out. And I always believe that in the long straddle scenario that you want to leg out of the trade. But ideally, I want to sell the call and get a profit on the entire position from just one side of the trade. Now, implied volatility actually is going to start helping us out a little bit again, because the market actually went down as far as implied volatility was concerned when the news hit, as far as the tariff news. Now, implied volatility is going back up. And that is one of the things that we were anticipating may happen as we go into earnings. So you have two things that are happening: is that Apple is down again, and the market going down is helping with the implied volatility, but also the fact that Apple is going to be announcing earnings on the 1st. So we're going to start seeing implied volatility creep back up. So on my position, I could get out at even right now. Apple's now showing weakness. I'm going to continue on in the trade and anticipate that implied volatility will probably increase heading into earnings. And I do think the stock is just showing weakness. It's kind of sad, to be blunt. I think everybody wants to root for Apple, a great American company. And it's not necessarily, overall, Apple was getting a little bit frothy. But it's always kind of been a little bit frothy. But the market conditions were getting a little weak in Apple. But then you throw in what's happening with the trade war and everything, and then Apple becomes a very tough company to own. All right. So here's my scenario. If you have the long straddle on and you put it on at 95 and you didn't sell the call side of things or the whole thing just to get out, the market's not doing what we wanted it to do. We got the news. We didn't get the huge event to the upside. So now either you stay the course, you ride it into earnings, you hopefully get a bump up in implied volatility, and maybe the put does the work for you. But I would have sold the call on the upside. Basically, the news, we did the trade on Friday and the news came out on Monday. And bluntly, I thought, well, wow, that was perfect. We did it. We did exactly what we were supposed to do. But the news just didn't propel Apple up towards, anywhere near its all-time high, let alone fill this gap. I was kind of hoping that it was going to go from here all the way up to the 220 level that we talked about. And it didn't happen. Now we're back down. Now who knows where we're going next. Earnings is a catalyst. Well, here's the bottom of this gap that was over here. And we're just kind of hanging out right at that level, actually. Interesting. Right there. So a lot of chop, a lot of area. And if we do break down below 195, obviously we could go back to the recent lows down around 170 in that range as far as the chart is concerned. It's still just a very, the chart doesn't look good either direction. This was the best thing that we had happen in Apple, that we broke. This is where we broke down the first trade war situation, and we kind of hung out there, and then we just dropped precipitously, gap down, and now you just kind of think that it's going to fill that gap, and it just didn't. And that to me is if I was going to go any direction, I'd be bearish on Apple. Let's put it that way. And looking at the chart, looking at the fundamentals, looking at the news, they're willing to make a spend. They're trying to do everything. They said that they committed capital to, I don't know exactly, but manufacturing some things in the United States. It's a little fuzzy exactly what, but Apple is willing to work with the government, and it still doesn't seem to be panning out for them. That's simple. All right, now let's go back. Bank of America. We did that trade. If you have any questions about the Apple position, I'm more than happy to try to address it. It isn't really it's not a trade that you can trade periodically. Like we have the butterfly. The butterfly trade actually is going to turn out to be okay on the trade because we did have the downturn today. But butterflies you can talk about every once in a while. When you're looking at long straddles, you need to react to the news when the news hits. And in Bank of America, we did an earnings trade, and that trade is working out all right. Market is down a little bit today, but after the news hit yesterday, we bumped up to the 38 level. It was a very profitable trade. At this point in time, I'm going to run over the what if calculator. You're still profitable on it. And if you didn't get out yesterday, which, I don't know why you wouldn't have. You always want to trade after the news event, after the stock ran up to that 30 level. Let's send a ticket. 38 level, I'm sorry. And now it's 146. So you're up 50 cents on the trade. I think we did it. We might have did it for 95. Or was it 90? Bank of America was 93 cents when I took my screenshot. I think we said 95. You're up 50 cents on it, but you should have been up close to the $2. After the announcement, the stock did run up to around the 38 level and then kind of faded, just kind of slowly gave up a little bit of the momentum, just right along with the market. I think that's the biggest reason why. Solid earnings report. And that's what we were anticipating. We did a 50-50 bet. We bet 95 cents to try to make $1.05 or you could say we invested 95 cents to try to make $1.05. And if you got anywhere close to that dollar, as soon as that trade is announced and the market moves, once again, you sell on the news. Usually right around 10 o'clock is when I'll get out of those positions, especially if it moves in the right direction. So the Bank of America trade worked out well. Go and take a peek at that chart too, I guess. Here's the high that we hit, 138.68. Oh, that is, I didn't even notice that it came right to the top of that candle. That's where the highest note was at. And then we closed near the high. We closed right at right at 38, right where our short strike was at. And now we're at 37.60. All right. And we have until Friday. I just close out the trade, get out of it. That simple. If you didn't do it on that day, I would just get out of it. The market weakness is back and you're up 50 cents on the trade, and that's not bad. We're looking to make 80 or 90 cents and you're making 50 cents. Get out of the trade. Next, what do we have? SPX. So the SPX trade, we were looking at it on Monday, that we were talking about on Monday, and my quotes wouldn't come up for some odd reason, and sometimes I've had an issue with SPX quotes. Needed to reset my computer, but couldn't do it in the middle of the show. So here's where the market's at now. The market is now down 50 points today, and it's trading at 53.41. 53.40 is where we're showing here on the way down. This is where we'd like it to land, and these things have one day to live. So right now, let's send that to ticket. We paid $2 for the trade, I think. And we can now get out for 146. Oh, and now it's 60 cents. It was 146 earlier. I would get out of the trade. You have to close it out. Try to grab this, whatever you can on it. And if we fall short on this trade, if we don't get to 52.60, this is going to go out worthless. So I would grab the coin that I can grab. And if we send that to the ticket and we go look at the trading for the SPX, you'll see that there's still some value in that one option contract that we had. And here was the adjustment that we were looking to make on the trade too, interesting enough, in that the adjustment would have been that you sold this one and you bought that one to close, and you would be short the 52.45. And you could have got it done and got out of the trade for break even. Looking like right now, I mean, market would have to stay above 52.45. You would have been short one short put spread, which wants the market to end up above 52.45. So here's how the adjustment would have worked if we could have looked at those quotes on Monday. Is you get rid of this option contract. Don't forget that it's there, but this is going to be removed because the trade adjustment would have been to sell to close. I'm going to put open in there, but sell to close that option contract and then buy to close this option contract. And if you did that right now, it looks like it's about $1. I don't think it's worth it doing. Oh, this is the 35. This needs to be the 60. That's why that's saying that. 52.60. Oh, two of these. There we go. So now it's about $1.90. But that would have been the adjustment, and we paid $2 for it. You could have adjusted it on Monday and received about the $2 net credit to bring it into the account. Now it's only trading for $1. And if we just sold it and got out, it's looking like we were talking about 60 cents on the trade. I would have closed it out on the open. I wouldn't have wanted to mess with the market. The adjustment would have been a little bit scary to do today. I would have been okay with doing it on Monday, But this marketplace with this volatility is a little bit scary, but this is the adjustment. You would close the 52.60, remove it, buy to close the 52.45, and then that would then you would end up with being short one of the 52.45s. You would have been short one of these. And I'll do that. Let's just do it this way. And then our ending position would have been short the 52.45s and long the 52.35s. And that would have been a short put spread that wanted the market to stay above 52.45. At this point in time, we look safe, but man, another 50 points or so, this trade gets really scary. And we're only down 1%. 2% move in the SPX is commonplace for the markets nowadays. 2% to the upside, 2% to the downside. Those types of swings are normal. They used to not be. It's kind of highlighted by the VIX too. I mean, the VIX does react to actual volatility, not just implied volatility, but the VIX is still trading right around 30%. Our VIX trade is looking pretty good going out to May. So we've had a little bit of settling down in the actual VIX index and the volatility. That trade is turning out just fine. We'll come back and we'll rehash that. All right. Any questions on these trades that we had on? If you did not already get out of the SPX trade, I would now. I don't think I would do the adjustment. The adjustment's already moved. So what is the actual trade then? Let's go back to the what if calculator. And you could potentially wait a little bit. I don't. Here's the thing. You got long time decay right now from this point going forward. From this point going forward, everything's freezing again. From this point going forward, there's going to be a boatload of time decay on those option contracts. So on the long butterfly that we have on, this is where the trade is at. If we send this to ticket, it'll be interesting to see where the price is at because we're still moving down. Now we're at 50 cents. So from this point on until the close today on these option contracts, time decay is going to be an issue. You're not at the 52.60 strike that we need to be at. You're getting a little bit of juice, but that juice is going to go away rapidly. And that juice is all being provided by this one put option, which is still trading for $3.35. As every hour that goes by, you could see this thing drop by 30 cents. So boom, 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 all the way into the close. I would get out of the trade right now, not try to live to see if it gets down to the 52.60 range. All right, let's go in and look at a Netflix trade. Netflix is announcing on Thursday, and this is one of the, you can almost say this is a darling of the stock market. Not worried about tariffs, right? It's not in that realm. The market, it has held up. We're obviously not at all-time highs, but there's not many things that we're at all-time highs at. But it's, got a little bit of a downturn with the market, but we came back and we're sitting at a real interesting spot as far as Netflix is concerned, if we can break out to the upside. So here is a little bit of a head and shoulders pattern that we have going on. Looking to, touch tier a couple of times, touch tier again, see if we can break out and go back towards those all-time highs. Maybe we can get that catalyst from the earnings report in order for us to make that breakout to the upside. So I want to be in this marketplace. I want to look at a neutral to bullish trade, and that trade is going to be the SPX. We're going to sell some premium all the way up near that all-time high. We're going to go about a 1 standard deviation move out. They're announcing on a Thursday, which always makes earnings trades interesting when you can do a 0 DTE option. So basically trade the Friday options after the announcement, and you have 1 day to live on the trade. But Netflix is the one stock that has managed to, hold its own. And once again, no worries about the tariffs in general as of right now. So the stock is actually doing okay. So here we go. Let's go back in. It's always at an inflated rate, but it's been that way for a long, long, long time. A lot of people that have tried to short it have really, got their teeth ripped out from it more than once. Here's the earnings report. It's going to be on the 16th, which is tomorrow after the close. I would probably look to set this up closer to the close, but we don't have a show tomorrow. Just always keep that in mind when we're doing an earnings trade. But I don't mind this earnings a trade. We got an expensive stock trading at 132 implied volatility right now on that near-term option contract. We're going to go about a 1 standard deviation move out, which I really like this range because if we look at the chart, your 1,050 on the chart, the all-time high here is 1,060. So once we get up to this range, it's going to be kind of tough for this market to break out to that new high, and that's where all our risk is at. Not saying that it can't happen. An earnings report could propel it that way. But once you get to this range right here, there's going to be a little bit of resistance to the upside. All right, so here's the trade. We're going to go, we're going to buy the 1 standard deviation move out, which says there's a 16% chance based off of the implied volatility of 131. So a little bit more than the expected move, and we'll look at that here second. But we're going to look at buying the 1,050 strike, and then we're going to sell the 60 strike. Now, once again, when you're doing this trade, I like to think of it that we're selling premium, not necessarily that we're buying a butterfly. We want to bring in a decent amount of premium. The butterfly gives us a little bit of protection if the market moves against us. So we do that, and then we skip the 1,070 and we buy the 1,080. All right, and we can get this done for a 36-cent net credit. If we just did the trade outright, you're talking about if we just sold the put spread, okay, 34-cent net credit. Let me send that to the what if calculator. Okay. And we'll go back to trading. If we just sold the spread, okay, we just sold the spread. The spread that we're talking about is the 1,070 and the 1,080. So if we just sold that, you'd bring in a 77-cent net credit with 10 points of risk. We're going to do the butterfly. We're going to bring in about 35 cents, about half of that, but we have a hedge in if the market goes against us. So ideally, you're taking that position, and by skipping this strike, you're using that to pay for the butterfly. So let's remove the strike that we're skipping, the 170, and go back and put the trade on. Okay, so here we are. Buy. And hit the bid twice and sell. No, it was 150. I'm sorry. Buy, sell, skip, and buy. And that's 35 cents. So this is the official paper trade. We're going to use the April 17th, this Friday expiration, knowing that Netflix is going to announce earnings after the close on Thursday, the 16th. We're going to go more than 1 standard deviation out of the money, and we're going to buy the 1,050 strike call, sell the 1,060 strike call 2 times, skip the 1,070 strike call in our butterfly, which would make a standard butterfly, and then sell the 1,080 strike call. We're going to do this. Well, right now, I really like that net credit. I like 40 cents. If we could get 40 cents, I'd really like to do that. But let's be realistic. I don't know if we can get 40. Well, I'll say 40 cents. If we can get 40 cents, that's a really good trade because you're paying, you would have received about 30 or 70 to 75 cents if we just did the short spread. So if we can get this done for 40 cents net credit to the account, that would be a solid trade going in on Netflix. You have $1,000 worth of risk. minus that 40 cents received. High probability that it won't get there. If it does, and it stops short and it lands right around, like, ideally, if the market opened like at 1,030 and started drifting up this way as we went into the close on Friday, that would be the best case scenario. Because if it did go out at 1,060, you could actually make $1,000 on our long spread. And that would be the way that we could approach that trade. All right. So we got a couple of comments. I like this trade. I like this one. Oh my gosh. That is a good point, Anthony. So if we do this on Thursday, these option, we do got the Friday, the 17th expiration, but we can't trade out of it. That's a really good question. I'm not sure, Anthony, how we would get out of the trade. It will expire on Friday, and then it's just would be a situation of uh, exercise or assignment. Well, the actual expiration date is Friday the so it's going to close. Oh, so these are this. Oh, they adjusted the expiration date. Thank you, Kurt. So this trade isn't going to work because they're going to announce earnings after Thursday, and these won't live. Wow, I got an egg on my face. May 16th, May 9th. Well, this would totally adjust the trade if we go out to the 9th. You know what? I don't mind that trade right now, actually. Let's keep that trade on. This is a Thursday expiration. We have, and we're getting it done for 40 cents. But the vol, all right, when is Netflix going to announce? Because it doesn't, then why is the vol 130? Thanks, Anthony. But why is the vol 130? That's very weird for them to announce after the close. Let me, which they always announce after the close, Netflix does. So they might be announcing early. So everything might apply if they're announcing before the open on Thursday. Does anybody confirm that? Let me run into. Because it does not make any sense that Netflix implied vol would be 132. So they have to be announcing before the open on Thursday. And I mean, I'm totally befuddled by that. Options play. because this trade still makes sense, and I don't understand why it makes sense. The straddle is $30, so you're talking about 60 points is the straddle. So I don't think it's that bad of news. Hmm. I'm getting mixed responses. Okay, 29 plus 29, 58. So we're talking about divided by 979. Yeah, it's saying about a 6% move based off of 1 day's close. Looking at the long straddle, April 2nd, we're trading at 132% implied volatility. But I'm showing that the earnings is after the market is, well, let's find this answer. Anybody else got a source that they're looking at? Yeah, it show the earnings after the close, but it doesn't make sense that it would trade at this level. Well, this is a very interesting question, just in general. The best place to go, the best source to check it out would be to go to Netflix Investor Services site and check it out there, because that's where the reporting comes from. So let me try Netflix Investor Services and see if they're highlighting where that spot is. Because it makes zero sense that the implied vol would be 130, the expected move would be 6%, and all that news happens after the close on the 17th, and the 17th is actually the expiration date, not the 18th. Huh. And I'm seeing it again that it's supposed to announce, according to NASDAQ, it's supposed to announce after the close. So I think we do the trade. I think you sell some vol premium. Now you'd want to close this out. You don't. I mean, I guess here's a risk. An early assignment risk could happen, right? And that not an early assignment, that the markets could close on Thursday, the stock moves, and somebody could put in an exercise notice on your short option contracts. And there's a lot of things at play here, because you can still exercise after the close. This is actually like an entire seminar in one trade. Yeah, Anthony, mine too. The best source would be uh, Netflix Investor Services. Sometimes it's hard to find that information inside there. Um, Investor events. Interesting. All right, I'm gonna okay. Let's move out. Let's move back full screen, and I'm gonna try to bring this up because that makes it really interesting on the trade. There is because you got to realize that uh, so I'm in. It says upcoming events, April 17th, next quarter earnings, and it does not say. Yeah, 1:45 p.m. Pacific time. So even on, and I'll show this because this is still really confusing to me that they would do this. No company does it, and then there's no trading the next day. So go ahead and put that up. April 17th at 1:45 p.m. Eastern time. So that's after the market. I'm sorry, Pacific time. And that's after the markets. And it's saying that this is in Netflix Investor Services. Um, So this makes this so interesting. Let me pull this back up. We're still trading at that vol, and the announcement is after earnings, and the expiration is after earnings. So now what we have all the math works as if this is a Friday expiration after the earnings. Hmm. Well, I don't mind this trade. I don't mind putting this trade on. I probably want to close it out before the event because once again, I'm worried about getting assigned early afterwards. But what else could we do on this trade? If you're going into the close, here's another, and 145. So if you have access to your broker, if you can call and exercise, uh, you see where the market is at, you do an exercise and assignment on your option contracts. Do you buy a call option and then exercise if the market's good? Well, you have to know what it is afterwards, and you have the risk that the after hours. All right, so let's put this to a test. Let's think about this, everybody out there in webinar land. So if we put this trade on, I'm gonna put the trade on. It makes sense to me. I don't understand why I wouldn't. You're getting the vol premium. The news is coming out after the market. We could pull in that 30 cents, go one standard deviation. As a matter of fact, I might even move it up now, knowing that the news isn't going to happen. Maybe go to the 145 and get a little bit better credit. If you shift everything down 5 or even 10, but stay within a one standard deviation move because it still could happen. But here's the other alternative. Think about this. So you come out and you buy a call option on Netflix and you have limited and known risk. So I get rid of that trade. We're going to have limited and known risk on the call option. Still got to pay up for it though, don't you? So you wait till tomorrow going into earnings and you buy the 140 strike call or something out of the money. Should be trading for a lot less on the close. And if the market takes off, you exercise it. You put an exercise notice in after the market. The market could be down here, but then you put an exercise notice and you make sure your broker knows that you're going to do an exercise notice. If it goes down, you just lose the premium that you paid for the call. If it takes off, you can exercise and you go long stock. But that only works if implied volatility comes down a little bit. This is really interesting. I don't even know what to say. And Anthony, thank you so much for piping in. Yeah, we're gonna have to go. We got to call it a day. I see what time it is. Let me go here and we'll answer. Let's go out to the full screen. Doug says I put on a 5 wide 25 Delta Iron Condor for $3. I like it, Doug. Doug, I like it. You just if there's something that might close in the money, your risk as early as is assignment after the close, Doug. That's kind of one of the landmines that you could be assigned. Excuse me, after the close on this trade. So that is the risk. So be aware of that risk, that if the market closes and your options are out of the money and the after hour trading happens and they end up in the money, you might get assigned on your short calls and not be able to exercise your long calls, Doug. So I like your trade, but if you're close to one side of those, you don't know if you should exercise or not. Does that make sense, Doug? So let's say I'm short a call and the market is going up, and then I have my other call as protection. So I buy the other call as protection. The market stays neutral during the day. The news comes out, the stock jumps. Those short option contracts may or may not get assigned. And you don't know if you should exercise your long option contracts. And if you don't exercise them, you're just going to be short Netflix. This is a scary, scary situation. Man, this is a scary situation. All right, I got to call it a day. I got another seminar I got to do. Thank you so much for all this. This is a wonderful discussion. Yeah, Netflix right now, indication. I don't know why they wouldn't change that and announce earnings before the open. All right. Take care, everybody. Thanks for attending. Interesting day on Options Guy TV. We'll see you on Friday. Well, we won't see you on Friday. We'll be doing an education piece on Friday. We'll see you on Monday for the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.